1. The silent overpayment. Every year, seniors across this country overpay their federal taxes. Not because they're doing anything wrong. Not because they're careless. Most of them are filing honestly, on time, exactly the way they have for decades. They're just following habits that made sense in a tax code that has since quietly changed around them. And the system doesn't correct them. Because the IRS is passive. It doesn't check a box for you. It doesn't say, "You're 65 now, here's what you've earned." It waits. And if you don't know to ask for something, it assumes you don't want it. Most people file the same way they did at 52. Same forms. Same habits. Same assumptions. And every year they do that. They leave money that's already legally theirs sitting untouched. Here's what most people don't realize. The tax code doesn't just have rules about what you owe. It has rules about what you're protected from. And those protections grow, specifically, meaningfully, the moment you turn 65. Let's start there. Chapter 2, The Foundation, Your Standard Deduction. Every taxpayer in America gets to subtract a standard deduction from their income before federal taxes apply. Think of it as a protected zone. Income that falls inside this zone is simply not exposed to federal income tax. For the 2025 tax year, the return most people will file in early 2026, the standard deduction is $15,000 for single filers. $30,000 for married couples filing jointly. That's the foundation. Every dollar of income that fits inside that number, protected. But for anyone 65 or older, this is just the floor. Because there are two more layers sitting above it. And most people, even those who've been filing taxes for 50 years, have never claimed both of them. Chapter 3, The Age Bump. The first additional layer is built directly into the tax code. And it activates automatically at age 65. The standard deduction goes up. No application. No special form. No extra step. Just age, and the law. For the 2025 tax year, single filers age 65 or older get $2,000 added to their standard deduction. Married couples where both spouses are 65 or older get $1,600 per spouse, $3,200 total. So a married couple, both over 65, now has a protected zone of $33,200 of income that never touches the federal tax brackets. Not reduced. Not taxed at a lower rate. Protected. Now, here's a story worth knowing about. Margaret is 71. Retired schoolteacher. Has been filing her own taxes using the same software for years. Every year, the software asked her, "Were you 65 or older on December 31st? And every year, she clicked past it, not realizing what that question was unlocking. She missed her age-related deduction increase for 4 consecutive years. At her effective tax rate, that came to roughly $500 per year in unnecessary overpayment. $2,000 gone, not because of anything complicated. Because of one prompt she didn't know mattered. She caught it, filed amended returns for the years still within the IRS's 3-year window, and recovered $1,500 of the $2,000. The other $500, the first year, was too old to claim back. Gone permanently. Not because the rules didn't allow it. Because the window had closed. Not everyone catches it at all. Margaret's situation, one missed checkbox, years of quiet overpayment, is more common than most people realize. And what happened to her with Layer 2? Happens even more often with Layer 3. Because Layer 3 is newer. And bigger. Chapter 4, The New Senior Deduction. This is where the numbers get serious. As part of sweeping tax legislation passed in 2025, commonly known as the One Big Beautiful Bill, Congress created a brand new deduction specifically for Americans 65 and older. Up to $6,000 per qualifying taxpayer. For a married couple where both spouses qualify, up to $12,000. And here's what makes this powerful. This doesn't replace the age bump we just covered. It stacks on top of it. Layer 1, the standard deduction, $30,000. Layer 2, the age-related increase, $3,200. Layer 3, the new senior deduction, $12,000. For a married couple, both 65 or older, those three layers combined can protect up to $45,200 of income from federal income tax. Now, let's be precise about what that means. That's not $45,000 in tax savings. It's $45,000 of income that never enters the taxable zone in the first place. For many retirees living on Social Security, a pension, and modest investment income, that can be the difference between owing federal income tax this year and owing nothing at all. One important note, this deduction has a window. It was created for a limited number of tax years. After that window closes, it's gone. The years right now are the years it matters most. Chapter 6, the paperwork. Here's the practical piece. Because everything covered so far only matters if it makes it onto the return. The tax code doesn't reward what people know. It rewards what they claim. Form 1040-SR is the version of the federal income tax return designed specifically for seniors. The SR stands for senior. It uses larger print, a cleaner layout, and it includes a built-in standard deduction table for taxpayers 65 and older, which is where the stacked deductions are calculated and applied. The new senior deduction under the 2025 law flows through the standard deductions section of this form, calculated on the deduction worksheet. If using tax software, make sure the date of birth is entered correctly. When the software asks any question about age or senior deductions, answer it. Don't click past. That's exactly where Margaret's error happened, a prompt that looked minor but wasn't. Before submitting, find the standard deductions section and confirm the numbers match what was covered today. If working with a tax preparer, ask them directly. Have we applied the new senior deduction under the 2025 tax law, and is it reflected in my standard deduction? One sentence. That's it. A current, well-prepared tax professional will confirm it immediately. Whenever new tax benefits become public, someone tries to exploit them. This one is no different. Here's what that looks like. A phone call. An email. A letter with an official-looking seal. We can help you access your new senior tax refund. Small processing fee of $200. Sometimes it's a website. Sometimes it's someone claiming to represent the IRS. Let's be direct. There is no processing fee. There is no phone call that activates a deduction. There is no separate refund check waiting to be unlocked. These are deductions claimed when filing a tax return. That is the entire process. Nobody accesses this money faster by charging a fee. The IRS will never call to offer a benefit in exchange for payment. If anyone makes contact asking for money in exchange for something described in this video, hang up. Delete it. Move on. That's the answer. The real version of this, the one just covered, costs nothing and happens through a normal tax filing. Here's where this lands. 3 layers stacked. Layer 1, the standard deduction, $15,000 if you're single, $30,000 if you're married. Layer 2, the age bump, $2,000 added if you're single, $3,200 if you're married and both spouses are 65 or older. Layer 3, the new senior deduction, up to $6,000 if you're single, up to $12,000 if you're married. Maximum protected income, $23,000 for single filers. $45,200 for married couples, both 65 or older. Whether someone benefits from all three comes down to one thing: knowing these provisions exist, and then actually claiming them. 2 steps. Step 1. Open Form 1040-SR, through tax software or at irs.gov, and verify the date of birth is entered correctly. Check that the standard deductions section reflects the age-related increase. Step 2. Specifically confirm, with the software prompts or a tax preparer, whether the new senior deduction under the 2025 tax law has been applied. Don't assume. Confirm. That's it. The retirees who benefit most from these protections usually aren't the ones who know the most about taxes. They're the ones who took 10 minutes to check. Margaret checked, and got $1,500 back. Harold checked, and kept $1,800 he almost handed away. Neither of them did anything extraordinary. They just stopped assuming the answer was no. That's the only difference between leaving this money on the table and keeping it where it belongs. In your pocket. Now it's your turn. Everything covered today is about the federal return. Income. Deductions. The forms that make it real. But there's another place money quietly slips away from seniors every year. That has nothing to do with the IRS. It's the property tax bill. In many states, there are senior-focused property tax exemptions, reductions, and relief programs that can significantly lower, or in some cases eliminate, what's owed on a home. And in some counties, if someone qualified in prior years and never applied, there may be a way to recover money that should have been received. Many people find out too late. A deadline passes. The window closes. And thousands of dollars are simply gone. In the next video, we'll walk through exactly how these programs work. How to check if your county owes you money right now. And how to make sure that deadline never catches you off guard. Thank you for watching.